Welcome and thank you for joining us today. Hopefully you are in a nice, cool place watching this webinar and joining us. Our lunch presentation today is mid-year sales tax update. So today our state and local tax team will discuss recent developments in the sales and use taxes, including trends in tax collections, tax rate changes, and economic nexus development. So I'm Carolyn Powell. I'm the development director here at Tronconi, Scare and Associates. I will be your host today. There's a couple different ways you can engage with us. There is a toolbar on the right-hand side of your screen, hopefully. In there is a handout section. We have a copy of the presentation and also the bios of our experts today. There is a question box. Feel free to throw any questions in there. We'll get them answered throughout the presentation. And also too, if you're new to our webinars, shoot me a quick note, or again, if you have that aha moment today of something new that you learned, let us know what that is. After today's presentation, you will receive a link to a survey. Feel free to just fill that out. Let us know if the webinar was helpful for you today. If you want to set up a time to have a conversation with Tom and Gerad further about your particular situation, so feel free to give us some feedback on that. I will also email you this afternoon with a copy of the presentation and a link to the recorded session if you want to go ahead and listen to it or send it to another colleague that wasn't able to join today. So without further ado, let's get started. Tronconi, Scare and Associates is a certified public accounting firm and business consulting. Tom is a CPA with over 20 years experience in public accounting. He has a broad range of industry experience, being manufacturing, food, finance services, software, environmental, and electronic commerce. Gerad is also with us today. He has over 20 years experience also in public accounting and private industry. He's a former employee of New York State Department of Tax and Finance, and has a broad range of industry experience, being food industry, government, and IT. So before I turn it over to Tom to get us started, just want to touch base again on our objectives today. We'll be going over the recent trends, tax rate changes and new fees, economic nexus thresholds, advanced sales tax automation, and New York advisory option. So I'm going to turn it over to Tom to get us started.
Good afternoon, everybody. Thanks for joining us today. I guess I'll get a lot of people on the call, so everyone must have their sales and use tax returns filed for the month, with today being the 20th. Good for you. I think we're still wrapping a few up for some of our clients. So always a tax deadline every month when it comes to sales tax. So just to get things started, just want to talk about some recent trends that Gerad and I have seen with state and local tax collection, specifically sales and use. I always like to start off with talking about this report from Ernst & Young and the Council on State Taxation that they do annually, citing the amount of business tax paid to state and local tax authorities. It's always kind of shocking. You can see in the fiscal year 21-22 that businesses paid over $1 trillion in state and local taxes, which was about 45% of all the tax that state tax authorities collected. So if you take business and individuals, almost half of that comes from businesses. And everyone always goes about how much, income tax, that's all we hear about. But, if you look at the slide, you'll see that sales tax is the second tax on this list, that about almost 21% of all the state and local tax revenue coming in from businesses on sales and use tax, which makes a lot of sense if you think about all the different purchases that businesses make. So that's a big chunk, and sales tax seems to be going up as well. At least it has been back in this time period. I think we're seeing this year, some of the guidance I've seen or some of the reports I've seen from states is that their sales tax revenue is down a little, depending on the jurisdiction. But you can see property tax is number one. It's always going to be number one. It's always on the top of this heap here. That's the biggest revenue source for state and local tax authorities. But sales tax is, in second place, way ahead of income tax. So everyone who puts all their focus on state income tax and sales tax, don't worry about it. Well, sales tax is a bigger piece of the pie for the states, which means they're going to have put a lot more importance on that, and their activity and their actions and their focus is going to be on that pretty intensely. So I'm going to kick it over to Gerad to talk about some recent trends we've seen with New York taxation.
Welcome, everyone. A couple things we wanted to point out to you guys. We're putting the slide deck together. We noticed that the comptroller published a report showing that the local sales tax collections for New York had actually returned to pre-COVID amounts around 23 billion. And what was interesting to us is as we're looking at the slide, over the 2021 to 2022, there was some pretty significant increases in local taxes. And what we're guessing is what's driving those increases was, folks about that time during COVID, they were receiving stimulus checks, and we're thinking people were taking those checks and buying, building materials, and they were doing improvements to their homes and those types of things that was driving up the local sales tax collections. And then the other thing is that, a lot of folks are shifting their buying behavior from going to stores to purchasing online. And we'll talk about it here in a second, how e-commerce is moving up the chart as one of the areas where the states are focusing on collections, and they're receiving a significant amount of sales tax dollars from e-commerce. And then just one last thing before we move to the next slide is e-commerce now is the top 5 source of sales tax in New York State. And because of the marketplace wayfare changes, the state's estimating for 2023 that the collections attributed to that change were 2.6 billion. So e-commerce is definitely playing a significant part in sales tax collections. So on the next slide, what we found in the comptroller's report is he did a nice job. Since we're in Erie County, it's nice to kind of take a look and see what's driving, what businesses are driving the sales tax collections across the state. And so what we put on the slide was a breakdown for Erie County. And the one thing we want to point out is that the top 3 items actually make up about 40% of the collections in Erie County. So that's car dealers, restaurants, and then ranking 3rd is electronic shopping, and that continues to climb, obviously because more and more people are purchasing online. And then one of the challenges is with online businesses is, obviously economic nexus is front and center for many states, and we'll talk a little bit later on about keeping track of your economic nexus and when it's the appropriate time to register, because many states are assigning groups of people just to watch registrations, and like I said, we'll talk a little bit more about that later on in the presentation. On the next slide, a couple things we want to point out, and especially in New York, something to be aware of is exemptions are available both at the state and the local level, and some exemptions cover state and local, where others may just apply to the local taxes. And probably one of the more notable changes in this area is Monroe County. So one of the things when we gave this presentation here a couple of weeks ago, we just pointed out that we're kind of in that time where folks in the past used to go to Pennsylvania to buy their clothes, so they didn't have to pay New York sales tax. Not saying they don't owe New York when they bring it back, but they were trying to avoid the sales tax in New York, and they would go to Pennsylvania. So we kind of have that situation now where recently Monroe County just enacted an exemption for the local taxes on clothing. So for example, how local exemptions work is you could buy clothing in Monroe County tax-free, but if you were to come and shop at the Galleria Mall, you'd have to pay 4.75% taxes on your purchase. So those exemptions are out there. And then the last thing I just want to point out is which is a pretty popular exemption at the moment, is the solar exemption. It's available for both commercial and residential installations, and that applies to the solar equipment on a project. So if you have that particular issue, there's something you might want to reach out if you have a question, let us know, or something to take a look if you have a need for solar. That's something you're considering for your business.
So as we were talking about economic nexus and how electronic commerce has become a big part of New York State tax collections, we saw some reports in the NYSAC controllers report that 61% New York, I should back it up here. New York enacted an economic nexus change back in 2019 following the South Dakota Wayfair decision in June of 18. And since then, about 61% of the total tax collected from electronic commerce in New York is really kind of stemming from that change. So about $2.6 billion that's been collected, in New York City, and the other 2.6 billion in, total, like almost $1 billion in New York City, and one other 1.6 billion in all the other 57 counties of the state here. So you can see that's had a significant impact on, filling the state's tax coffers with additional revenue that, if not making that change, that number would be down considerably. It'd only be about 30% of that at this point. And what we've seen too in some reports, there's not a lot of up-to-date reports, but from a 2022 Government Accounting Office GAO report, you could see that there was about 33 states that had collected about $23 billion just due to making this economic nexus change with Wayfair. So that was based on 2021 collections. A lot of that could potentially be skewed because of the pandemic and COVID and people buying things online. But any way you cut it, this economic nexus revolution that came about for sales tax back in 2018 is really benefiting the states. And, another one of these trends that we're seeing related to this when it comes to, remitting sales tax is, there are issues with sales tax simplification. That was one of the things that, the Supreme Court cited, when they sided with South Dakota against Wayfair, was that, the returns need to be simple. It's got to be easy for businesses to, collect the tax, prepare the returns, remit the tax to the states. And the sales tax simplification issue has been one of those top 10 hot trends that we've seen for years. And most states, filing your sales tax return isn't too bad, right? You have one return for the state and the local authorities, whether it's counties, cities. You might be saying, Tom, if you file the Texas or California return, those are crazy. Yeah, they are, but it's one return. But there are states out there what we used to call the home rule states that include Alabama, Alaska, Arizona, Colorado, and Louisiana that allow their localities, like a city or a county, to administer and collect their own sales tax and make their own rules up as well. So this really impacts a lot of retailers, especially the remote sellers, in how do you handle these home rules. Now, it's super challenging, may affect the number of returns you have to file depending on the state. And does this really meet the spirit of the law with the sales tax simplification that was cited with Wayfair or South Dakota? A lot of states, these states especially, realize that this compliance is difficult for businesses, and they're working on it. And thankfully, we can see here on this slide, Alabama. If you're a pure remote seller in Alabama, you exceed their $250,000 economic nexus threshold, you have no physical presence in the state, then you can collect their simplified seller's use tax, their SSUT. You file one return with the state, and it covers all their localities, whether they're state administered or their home rules. And I think you do it at an 8% rate to a flat rate. So really easy to do. So that's a good job on Alabama with there, because otherwise Alabama's a nightmare when it comes to filing sales tax returns via physical presence. Alaska, Alaska doesn't have sales tax statewide, but they allow these localities, their cities like Anchorage and Juneau and Sitka, to collect their own tax if a business has over $100,000 of sales into the state, statewide. So they've set up a remote seller sales tax commission that's working towards a simplified single level statewide administration for the returns. This way you're not filing multiple returns with Alaska. Now, I don't think I have any clients. I had one that did a couple cities in Alaska back in the day, but I don't really see Alaska too much out there. Yeah. Arizona was a nightmare with their cities and localities, but the Department of Revenue now is a single point of administration and collection of these state and city taxes, including the city licensing. So that's gotten really easy. Kudos to Arizona for really taking the lead on making this simple for businesses. On the extreme other end of that, we have Colorado. Colorado used to be really, really bad. Colorado has multiple home rule cities and counties that would collect their own tax, including big ones like Denver and Boulder. However, Colorado's working towards implementing their new system called SUTS, S-U-T-S. It's a single point of remittance for state and local taxes. Also has a nice geographic lookup where you can find tax rates and a tax matrix. And they're kind of requiring all the cities and the cities to kind of join into this and codify their rules, to what the state has, because if they don't, they're not going to be allowed to collect tax. They're not going to say, okay, well, we might have 100,000 in the state, but you know what, you don't have physical presence in the city, so you can't collect the tax. So Colorado's gone a long way to do that. Suits is pretty much live. I think there's maybe 2 or 3 now localities that still aren't in it, but are working towards it. So that's great. And then finally, Louisiana. Again, if you've ever filed sales tax returns or dealt with Louisiana and the parishes, you know what I'm talking about here. Some of the parish taxes are administered by the sheriff's office, the local school board. It's wild down in Louisiana with, and not just on Bourbon Street, it's wild when it comes to sales tax, believe me. But they have done some work, with the Remote Sellers Commission, that again, like Alabama, you can file a single return with a single rate if you're a pure out-of-state remote seller. If you're in state or have fiscal presence, you still have to deal with the parishes, and they're very reluctant. Louisiana's tried multiple times in the last few years to, make adjustments, but they can't get anything passed in the legislature. So very difficult, but at least it's getting easier in these states to file your sales tax returns, remit your tax, and because it is very complicated for sellers dealing with these tax authorities. So Gerad, what do we have on some more recent trends related to sales tax exemptions?
So when I started in sales tax, I was made sense. Yeah, it was a while ago, and I was doing sales tax audits for New York, and that's where I learned a little bit about, like why certain things are taxable, and you start to understand the policy behind it. And what I thought was interesting is New York would tax things like, when it comes to food items, they tax soda and candy, and it's a way of trying to discourage folks to, maybe consume those items and not have to pay taxes on things like milk and, eggs and bread, those things which are more essential, food items. And then as I started to learn other states, I realized that there are other states that actually tax the sale of food items, the milks, the eggs. And I was surprised by that. And, they do tax at lower rates. So for Virginia, for example, at one point it was 2.5%. And recently they reduced it to 1% to reduce the burden on folks that have to purchase those everyday items. And what we're starting to see across the states is that there are still 13 states that tax groceries in some form, whether it's a reduced rate or it's a select group of items. But many of those states are actually considering an exemption for grocery items. That seems to be a trend of late. One of the other trends is personal hygiene items, which could cover anything from feminine hygiene products to diapers, to other baby products that, might be taxed as, either a disposable medical item. It could be a clothing item, like diapers were taxed as clothing in New York.
Yep.
Even though it's not an everyday item, hopefully, because they're disposables. But that's some of the trends we're starting to see is those are the more essential items. The states are getting behind good policy to say, okay, we got to reduce the sales tax burden on our individuals and try to shift it somewhere else.
Yeah, you've really seen it a lot, like Kansas, Illinois, Virginia, they're all reevaluating this tax on groceries in recent years. And the personal hygiene products, that's a big thing. That's been going on now. There's even websites that list, what states are still collecting that and trying to get, sign petitions to get them to remove that sales tax, from what I've seen.
And that's where, when you get into, if you're a large company, you have sales in many states, the technology is helpful because, you can research to determine, some of these items may be taxed on one state, but not another.
Mm-hmm.
But it seems to be, many of the states are starting to align on some of these exemptions. So that's good to see. Now, just when you thought, okay, they're going to provide more exemptions or try to reduce your sales tax burden, they're going to grab, other things. So the next thing we want to talk about is digital goods and services, right? Which is super popular at the moment. Things you used to get in physical form, right? Everybody loves to read a good book, flip through the pages in their hand. Books move to, obviously this is nothing new. It's been like this for quite some time now. But many states are either currently taxing the digital form of things we used to get physically, books, software we could get off the shelf. Maybe, go into the old, the video store to get your DVD to watch, because that's going to date, we're going to date ourselves, showing that we knew films and music used to be sold on a disc. And, obviously technology changes, companies sell products in different ways. And then when companies do that, and if the states can't keep up with legislation, they start to lose tax revenue. They'll try to expand the definitions, right, to get back to where they were. And what we're seeing right now, one of the trends is states are chasing after software companies. So I would suggest, or, and I think Tom would agree, is that if you're a software company and either you are licensing software, in New York or some other states like Texas, where they might give you physical presence, or if you have people on the ground selling for you or doing installations, you might want to think about what's your exposure, right?
Yep.
And that is a priority for New York State for sure. Some of my former colleagues have shared that, is that they're trying to identify software companies who aren't registered. So again, we're talking about software, but keep in mind, if you have other things like digital books, music, like, ringtones, those types of things, they might fit in a state's definition of tangible personal property, and then you might be required to collect.
Yeah, I think it was Maryland a couple of years ago created a whole class of digital goods that were taxable. I think I just read this morning, Louisiana is looking to pay for their income tax cuts by broadening the sales tax base, removing exemptions, and taxing a large scale swath of digital goods.
Yeah, and the other thing with software to keep in mind is some states will tax if you require a download version of the software, but if you purchase, if a company has a SaaS version, it may not be subject to tax. But South Carolina, for example, is a state that goes the opposite of most states, where they exempt the download, but they tax the SaaS because they think the SaaS is a service
Yeah.
and not the sale of a thing.
Yeah.
So it's things to be aware of. And again, states' definitions are different, and you may come to different conclusions depending on the state. So.
Oh, yeah. I had to laugh. I talked to my kids the other day, especially if you live here in Buffalo, you know what Media Play is, or you remember Media Play, which was a huge store that had books and magazines and DVDs and CDs and video games. I was telling my kids about the store, and they're like, why? Like, what? Like, why was this all there? I'm like, we just get everything electronically. I'm like, yeah, but we didn't do that back in the 90s.
Nope.
Yeah, things have changed a little,
You
guys.
physically went to the store.
And I saw the other day, they were trying to, like, there was a donation effort to try to save, like, an old, like, bookstore.
Oh, really?
Bookstore, yeah.
Things have changed, man.
All right, so let's spend a couple minutes on tax rates. What's interesting, and even I was surprised, because for a long time we've quoted that there's tens to 11,000s of rates across the country, and at this point we've now surpassed the 13,000 tax rates in the country. So why we point that out is obviously if you're doing business in multiple states. In certain states, the rates change by jurisdiction. Like New York is a good example. So if you have a foundation here, you're familiar with counties having different rates. Whereas like Maryland or New Jersey, it's a single tax rate across the state, which makes it much easier to collect and file in those states. But you go to Arizona, you go to California, Texas, they all have several rates across their state. So it's obviously something to keep in mind. And why we're pointing it out is if you look at 2023, in 1 year alone, and this is from a report we pulled from Vertex, which is a tax engine software that they research and keep track of sales tax rates across the state, there was 444 changes in 1 year. And they actually reported that from their information, it's the highest that they've noted in quite some time.
Mhm.
So just when we thought the states would slow down, they continue to find other ways to raise revenue. So if they're not trying to tax new things like digital books and SaaS offerings, those types of things, they might just raise the rate. And obviously, if you don't catch that timely, your company could be on the hook for it.
Yeah.
So we point that out because, as you can see, just you look at New Mexico or South Dakota, some of those rates could be significant, especially if you have a large presence in any of those states and in significant sales volume. And then the other thing on the flip side is, let's say you're a clothing business and you're selling in states that either repeal or reduce their tax rate on certain items to zero, where you might be over collecting. And that's just as bad as being in a position where you're under collecting, and if you're under collecting, you end up carrying the burden of that tax, and it's a hit to your business. Think about your customers having to pay too much tax,
Yeah.
and then they find out your competitors charging nothing or the appropriate tax. So that could be put you at a competitive disadvantage. So keeping track of rates is extremely important. It's something to be mindful of. Now this next slide is really just a chart we wanted to illustrate that when you look on average. When it comes to sales tax rates, it's pretty consistent across the states. We generally tell clients that in most cases, unless an exemption prevails, is that the average tax rate across the country is about 8%. Now, obviously, some states are lower, like Maryland, for example, is at 6%. But you go to California where they have jurisdictions that could go as high as 10.25% to 10.5%. And really, the point here is that if you're doing business in multiple states, at some point, you want to invest resources into keeping track of rates, or use technology that can help you, keep track of those, like the Vertexes or the Avalara's of the world.
Yeah, I think you can see from that slide that the average state rate is about 5%. But then when you start kicking in the locals, I mean, you get up to some states like Louisiana, Arkansas, Arizona, Tennessee, and Washington. you're getting up to over 9% sales tax. And when you get that high, I mean, that has an effect on your bottom line, right? If you're not taking that into consideration and you have an economic nexus, you should be filing, that's going to be a huge ding on you if you get audited or you get, caught by a state and have to come up and pay that tax out of pocket. So really the sales tax, can make or break you in a lot of different cases.
And Tom makes a good point is if you had an obligation to collect the tax and you don't, you're on the hook until you can prove that the seller or the buyer actually self-assessed and paid the tax themselves, which could be a huge hit.
Yeah, good luck.
And if you don't register, we'll talk about this in a little bit about registering timely is you expose yourself to audits that could go back, 6, plus years, right? Usually, if it's not protected by, by statute.
Yeah, I mean, and too, like trying to figure out if your customer accrued the use tax or were they audited for that period. Yeah, you can do it, right? Unless if you're selling retail goods, you're selling clothing, you're selling vitamins, you're selling something like that, high volume, low dollar sales, you're not getting that tax back from anybody. But, if you have good customers and you're a business that sells maybe equipment or something large dollar, yeah, you can send XYZ letters, asking them if they were exempt or they collected the tax or audited. But even then, I mean, you're getting 25% bounce maybe if you're lucky that they're going to respond to you. So really need to dial in on the sales tax in some of these cases. Real quick on this next slide, it's new fee trends. Really starting to see tax states, looking at new ways to collect, revenue from retailers and from businesses. Some of these we've, seen for a long time, and a lot of them they're calling them green taxes, or fees on products that, can damage or threaten the environment, with electronic waste recycling fees, battery fees, fees on single-use bags, not really taxes, so to speak, but it's stuff that you need to be, cognizant of if you're in one of these businesses, that you need to add this fee or remit this fee, to a state. I mean, the retail delivery fees that we're going to talk about in the next slide, that's something new that we're going to start seeing more and more of. And really, it's just another burden on the business. And whether or not you can, recoup that from your customer, is a big issue. So really, just to talk about two of these fees, retail delivery. This is a new concept. It just started back in 2022. Colorado was the first state to enact. Their retail delivery fee, requires a business to collect a 27% fee on all retail deliveries made by a motor vehicle to any location in Colorado if that order contains at least one item subject to sales tax. So this is a fee you have to tack on to your invoice in addition to sales tax, on every one of these sales. Now, they adjusted the scale of it, back in recently. I believe it was $1 million or $500,000 threshold of sales before you were subject to it. So that's at least one good. Minnesota's retail delivery fee is effective in July 1st of this year. That's a 50% fee on every order that exceeds $100, including clothing. However, it only applies to retailers that make $1 million or more of sales into Minnesota. So really here, they're going after the large volume retailers, the Walmarts, the Targets, those folks of the world. A lot more of the smaller, remote sellers shouldn't be subject to this, but hey, you got to be watchful. These are coming everywhere. New York, I know, has proposed one. It hasn't made it through legislature yet, but I could see that happening. So need to be careful about these other fees as well that can really impact your profitability. So Jared, let's talk about everybody's favorite topic,
Oh, yes, economic nexus.
economic nexus.
All right, we'll talk just quickly about what economic nexus is in simple terms is if you have sales into a state and you meet a certain threshold, you may have a requirement, you may be required to register. So for example, well, I shouldn't say for example, but the general trend is after Wayfair is that because Wayfair was 100,000 or 200 transactions, pretty much every state looked for that opportunity for additional collections and said, okay, we're going to copy South Dakota, and we're going to implement an economic nexus statute that if you had this many sales or this many transactions, you had to register in their state. Now, how you get there and what's the base to determine if you have nexus or not varies by state, and we'll talk about that in a second. But I guess the question is we always ask our, folks or clients or, when we're hosting a seminar is, how many of you heard of this? And I think a lot of people have, but there's still a number of companies that continue to ignore economic nexus rules. Now, what we just mentioned earlier is that if you don't comply with these rules, you might be on the hook for any of the taxes that you don't collect for your customers. And the other thing to keep in mind is it doesn't trump physical nexus. So if physical nexus still exists, if you got people on the ground, you got subcontractors, you got inventory in a particular state, these are all reasons that you might also have physical nexus. But just because you have one doesn't mean you might not have to pay attention to the others. So keep that in mind. There's two types of nexus now that you have to pay attention to, especially when it comes to sales tax. So on this next slide, the one thing we wanted to point out, if you looked at this chart a year ago, it would look different. What we're starting to see is that many states realize that the 100,000 is probably in most respects a reasonable threshold to set to say, okay, if you're selling this many sales in my state, you're in effect taxing the locals, right? You're using their infrastructure and other things to affect those transactions. That's the one way that states look at it is what they're starting to do is they're saying, okay, well, it's a huge burden for somebody that has, meets the 200 transaction threshold and maybe sells $5 items. So that might be a, think about how little $2,000 in sales, and now you're going to require somebody to register and file sales tax returns in those states for what might be $50 in tax or less. So states are recognizing that it might be a little bit tough for some of the smaller businesses to comply. So states are starting to 200 threshold to ease the burden on some of the smaller businesses.
And I think that's a trend. I mean, I think the multi-state tax council's on that, MTC's on that. I think they're really looking to have the states do this. I mean, I think it's important for them to drop this or 200 transactions in the near future.
Yep. So let's talk a little bit about how do you determine or how do you measure if you have economic nexus. We're going to just briefly touch on a few of these, but really what we want to point out is that it's different by state. So you can see on this slide, and I apologize for reading, a couple different, the bullets, but what I really just want to point out is you have to be careful with the wording in the statute is, for example, some states say either previous or current, and then the next group of states might say it's preceding or current. Now, you might come to a different conclusion depending on your state and your activity. So we just want to point that out, something to be aware of. Now, some states, like New York, for example, at the bottom, they say it's immediately for sales tax quarters. Now, what's unique about New York is that their sales tax quarter doesn't file, calendar quarters, it doesn't file fiscal quarters. Even their fiscal period is different than their sales tax quarters. So New York, there's really just no rhyme or reason. But it's something to pay attention to is that New York, like most things, they're different. And then some other states, it might be the calendar year before, but then they don't make you register until April the following year. So it makes it really difficult to stay on top of, the economic nexus rules and then determine when you should and shouldn't register.
I can't even make heads or tails of some of those. Like the third week of the fourth month after you hit nexus in our state, and they're all different. Some say the next transaction. Like, what are you gonna do with that? I mean,
So on the surface, it was good. It's 100 or 200, but when you dive in, it's amazing how different, the states, when they start to put their statutes together, like how they determine like what's the base period for registering. So beyond that, because that can't be simple, is the states will look at, all right, well, should we use gross sales? Should we use retail sales? Taxable sales, like in California, because it's California, they say, okay, well, we'll do gross sales, but it's only tangible personal property because they don't tax services.
mhm.
So that makes sense when you understand their tax regime, that they would only include tangible personal property. Now, so you can't use that as a basis to apply that to all of your state sales activity, because if you did, you're gonna get the wrong conclusion or the wrong
Yeah.
answer.
Yeah.
In a state like New
Oh,
York, it taxes both TPP and the sale of
Well,
services.
I love some of the gross sales states like New Jersey. New Jersey says, okay, if you're over 100,000 in gross sales, you got to register. But if all you do is make resales in the state, like just register and like we'll just waive you from filing the sales tax returns. Like, why? Some states say just don't bother registering with the gross sales. So like the retail, the next one is probably a better way to do it, right? With
Yeah, I think
retail sales.
Yeah, I think we can limit the retail or maybe just, your taxable sales.
Yeah, when you're excluding the sales from resale from that threshold count, I think that makes a lot more sense.
Absolutely. And then the other thing to consider is are you selling in a marketplace? Now that just makes everything extremely complicated because, is it your responsibility, is it the marketplace
Mhm.
to register and remit the taxes? Now, you look at the Instacarts, the DoorDashes of the world. Now, many of the states, and that was kind of the next phase of when economic nexus was passed and the states got behind marketplace legislation. And pretty much all the states now have adopted some form of marketplace or tried to say, okay, that's just part of our economic nexus. And pretty much what's happened is the burden of registering, collecting, and filing returns shifts from the seller to the marketplace.
Mhm.
So the Instacarts are selling for all the grocery stores that are on their platform, the PetSmarts and the Wegmans and the Topses and so on. But as you can imagine, that now makes your returns more complicated. And, the other challenge and what we see from clients is the seller and the marketplace remitting the same tax. So then, the state gets the windfall, but most times the seller shouldn't have paid the tax. And we're helping a client right now who had actually overpaid their sales tax because of marketplace sales. So it's something to keep in mind. And then the last piece, we're just on physical presence quick, is when do you register? As we were just talking about, as you can see, just the ones we put on the slide, it could be as quick as your next transaction. Now your next transaction might be $1 million sale.
Yeah.
And if you don't collect it, you're on the hook for it.
Mhm. So
you got to be careful. It's something to keep in the back of your mind, and if you ever have any questions, let us know. But it's one of those, it's still evolving and it's very difficult to be compliant, especially when you're dealing with multiple states.
Yeah, I think Kentucky is one of the ones that said next transaction, but they recently said, okay, we'll give you a 30-day grace period. But still, I mean, if you're not looking at your sales every month, or like, how do you get there, I mean, I advise our clients to look at them quarterly, but it's kind of difficult.
Yeah, so we touched on physical a little bit, and then just in light of time, I'll cut to the next slide quick, and I wanted to show you, this is a tool. Does it solve for everything we put on the slide? Not exactly, but it's a good place to start. This is a really basic schedule we put together for one of our clients, but you can see how complicated it is. Is a product taxable? When are they hitting it based on sales? And at some point, we might actually have to jump in and see if they have employees there, which then they have physical nexus, which you can see this is just a good tracker, to help keep track of that, whether you have economic nexus or not. And then the other thing to keep in mind is, can you even get the information?
Mhm.
Does your system support sales to, different states? And if you can't, then, it may be very difficult to find a way to comply.
Yeah, I think there's the one point with the physical presence. I think, a lot of companies in the last couple of years, especially since COVID, with remote workers, that's adding a whole new, realm of creating nexus for sales tax purposes, because you have physical presence in that state. They just might be an IT guy or a marketing guy or something like that, but they're not doing any service work or installation, but that's still physical presence. That still puts you on hook for sales tax, as well as your payroll taxes. And, if they are doing work for the company, they're not like a pure salesperson. You're starting to trip, income tax nexus issues too. So really something to be careful about. I mean, during COVID, there were some protections that the states put up against that, but now that's gone. So, you got to really look at where your remote workers are, not just from a sales tax perspective, but from employment tax and income tax, because it could really jam a business up these days.
All right, so our last topic, Tom, let's talk to the folks about a little bit about automation.
Yeah.
And, obviously we've given you tons and tons of reasons why folks would start to look towards automation to solve for sales tax. We're not here to push one technology over another. There's several that are out there. There's Vertex Avalara, there's Thomson Reuters, there's TaxJar. I mean, it goes on and on. But what we want to talk briefly about is, well, why would somebody do that?
Mm-hmm.
Think about it, if you're selling millions of dollars into various states, you're using spreadsheets to keep track of rates, whether your products are taxable, it's a very manual process. You could be spending hours and hours of time on things that can be automated, and you're not spending time on running your business. And, obviously sales tax is one of those unnecessary evils. You got to do it. But at the same time, if you had to prioritize where you spend your time, I think you'd want to be running the business and not, filing a sales tax return, but it's got to be done. And then you run into the risk of, people making errors in spreadsheets and the time it takes to, to file returns. And you go to other states and countries and you start to see businesses that are doing e-invoicing. So it really pushes for that real-time calculation, of sales tax. And then, states have tried this. Massachusetts was unsuccessful. They actually wanted at one point businesses to have a daily remittance of sales tax. Now think about if you weren't using this technology, how
would you do it? Yeah.
It's impossible. So the technology is more and more companies are starting to use it, obviously because of economic nexus and marketplace transactions and so on. And I would imagine more will in the future. But we just want to point that out as we're starting to see more and more companies leveraging this technology. And then one of the things, like we just touch on quickly is, like why are companies doing it, right? There's the time savings, the cost savings, the risk reduction. It gives you the ability to turn on a state much quicker than if you're doing it manually, or if you have a homegrown tax system where it requires IT to dedicate resources, which we all know when it comes to IT, it takes a lot. And I've experienced in many companies that it's not necessarily a priority for an IT department to help you, set up sales tax in, a particular jurisdiction. So, and then on top of that is just it's the real-time research that these companies provide as a good starting point to say whether you tax something or you don't. And it's just one of those things where the technology can really help you run your business, and it's becoming more affordable. So as more people are using it, it's going to drive down the cost.
Yep.
And then it's maybe what wasn't attainable in the past will be in the future. And again, the last the next slide is, what are some of the reasons to consider the technology?
Yeah, I mean, there's some good stuff there. I mean, a lot of these platforms, they have all the tax rates and the rules in a single system. We talked about all these tax rate changes and keeping up with them. Well, these systems keep everything up to date for you. You don't have to worry about collecting too much, not collecting enough. I mean, they have the correct rates in there. Some of them, like the Avalar, have a self-service portal for submitting your exemption certificates and tracking your exemption certificates. You can enter in the information. You have a digital image of that certificate right there. It bounces the tax collection off the certificate to make sure, you have the exemption. It lets you know when it's expiring. It's a great way, it's not storing them all in a file cabinet somewhere. A lot of, most today, your platforms are all SaaS-based, online-based. They're easy to sign into. There's no desktop version like you've seen with even QuickBooks moving to online platform only. There's standard connectors to the ERP systems. Most of the tax jars and the Avalaras of the world, they have built-in connectors that are really easy to integrate. It doesn't require too much programming, if none at all, depending on your financial reporting system, to really set these up. And I think like one of the main purpose are some of these engines, they're built for tax. They're built for sales tax. That's what it does. It's not some kind of bolt-on or afterthought to a bigger ERP type system or a bigger financial system. This is what they do. These systems calculate your sales tax, maintain your records, and make it easier for you to remit the tax. That's what I love about like a tax jar. If I've got a client with multiple sales channels, whether they have their own website, maybe they have some Amazon Marketplace, some Walmart, some Etsy, whatever you want, I can use that to aggregate all my sales together into one big file. So when we go to prepare the returns, I'm not pulling from all these different sources, making sure I have everything. It's all right there. So the advances in the last few years with this, ever since really Wayfair in 18, they've been tremendous and really worthwhile to take advantage of. And it's not just the businesses, the states are changing too. If you file sales tax returns in multiple states, there's big differences from one state to another in their online filing platforms. We've seen states like Maryland and Rhode Island and Maine and Pennsylvania who have some of the most archaic filing platforms out there have modernized them into, kind of similar type systems now. I've heard New Jersey and Michigan just did it. And New Jersey, thank God, is going to, because that system is brutal. And they're also realizing too, with all the online and everything being filed directly, states like Rhode Island, they don't need the reconciliation returns that they used to have. Hopefully Michigan and Hawaii kind of make that change too. So the states are making a lot of changes as well, which is good. So, and just, to wrap up, Gerad, we had some New York advisory opinions that, we've seen. You might look at this and say, Tom, how are these recent? They're from 2020. Well, that's still where New York is on advisory opinions in issuing them. They're still dealing with opinion requests that they got back in 2020. So I think we're kind of getting to the end of the road. If you look at some of the dates on these, hopefully we're going to start getting into 21 soon. But just there's some interesting things in here. Gerad, is there anything you want to point out? These are some of the ones we thought were pretty interesting.
Yeah, if you're pursuing solar, definitely look at that TSB or reach out if you have any questions. And then I think the other one that's interesting is the one that discusses the sale of hydrogen gas. So if you have like a trucking business or maybe some delivery vehicles where you're considering the use of hydrogen gas or compressed natural gas, it might be commonly referred as. There's special exemptions that are provided for that. And as you can see, they're green initiatives, so states are getting behind. but those are probably two that could be, important to your business if you're pursuing some type of green technology.
Yeah, and if you're in the digital space too, if you're a software provider or something in there, a lot going on with that too, with a lot of these advisory opinions, whether it's subscription fees to access online course libraries, digital marketing, hosting, creating websites, apps for mobile devices. There's a lot of stuff that's being, discussed in these advisory opinions that may impact your business. So it's always worth visiting and checking out New York's website, every once in a while. I mean, as much as we hit on New York, I mean, they do have a great bundle of resources on their website, whether it's the advisory opinions, the tax memorandums, the bulletins. There's not that many states that have the extensive research and guidance as New York does. So we're gonna keep it open if there's anyone has any questions for a couple of minutes. Just looking at the ones that came in. My buddy Mike Radovansky's asking how it's interesting that natural gas and energy increase is material percentage. Yeah, I mean, if you live here in Western New York, you kind of know that our gas and electric prices have gone up. That's part of it. The other part is New York. Yeah, New York got rid of the zero tax rate on the transportation of electricity and natural gas. Was that a couple of years ago already?
It was, yeah, you're starting to see it play in.
It's starting to play in. So it used to be if you purchased your electricity or gas from like a energy service company like an ESCO, but then you still had a National Grid or NYSEG or National Fuel doing the delivery or the transportation, that piece was exempt from sales tax. Well, New York got rid of that a couple of years back. So now you're starting to see that flush through and that additional tax revenue coming in. So, that's what happens to us up here. So can't have any exemptions. I mean, the legislature was nice enough to try and remove the sales tax production exemption on natural gas this year too. Thankfully that didn't go through, but that's everyone green, that they're trying to get rid of some of these exemptions here. But I think that's about it. I think we're about out of time, Carolyn.
We are. It is that hour to end lunch. So just want to thank everybody for joining us today. Thank you, Tom and Gerad, for all your insight and knowledge. Like I said, you'll receive a survey after this. If you could just complete it, let us know if you had any additional questions for our experts or if you want to set up a meeting with them directly. Our next webinar, July 23rd, will be cost segregation. So if your business is planning an expansion or new construction, this is a good topic for you for some tax planning and tax savings. And then on August 6th will be our life planning, and topics will be estates, trusts, gifts, and wills, and some other topics within there. So those will be our upcoming ones. I will email everybody this afternoon a copy of the presentation and recorded session. So thank you again for joining us today, and stay cool out there. Thanks, everybody.
Thank you.